Ticker symbol ORLY has returned over 35% in the past year, and today we'll be looking at a market leader in a highly profitable industry, which may be considered the perfect boring stock. Why? Well, because it has solid fundamentals, high efficiency ratios, and it is in a low competition, low innovation sector. So today we'll be looking at O'Reilly Automotive, an auto parts company. In their annual report, they state their mission as to be the dominant auto parts provider in all the markets we serve to both DIY, do-it-yourself, and professional service provider customers. So they basically target those two customer segments. The first one being DIY, or individuals and people who want to customize their cars, to change the parts, or to even fix them themselves. And the second customer target is professional service providers. These can be, for example, garages where people go give their cars, and these garages repair them or tune them and give them back to the customers. So in 2023, 53% of the sales were from DIY customers, so from individuals who are going to buy the parts, and 47% came from professional service providers, who are, as we spoke about, these garages who will then fix up cars for other people. This last segment is the one with the fastest growth rate for the past few years, and it does make sense because they do have the ability to consolidate demand, they have the ability to have way larger order volumes, and they just spend a lot more money on auto parts than individuals, or that's at least what I would think of. Here, they outline their growth strategy, and we divided it into 4 different parts. The first one, they say to aggressively open new stores. So by that aggressively, we can see that they're having a lot of demand currently, and that they have so much demand that they wish to actually open new stores in other locations to, first of all, try and unload the demand that they have from their current locations if some of those locations have been over demanded, and also to tackle other locations in the US, since they are seeing that it is a very good value proposition and that a lot of people are demanding these products. The second one is to grow sales in their existing stores, and they plan to do this through 2 different levers. The first one is through cross-selling, which is where, for example, an individual comes to your store to buy a new set of wheels for their car. Well, you try to sell them paint that you're buying as well, or a steering wheel. This is called cross-selling, when you're trying to upsell or sell a lot more things to your current customers. And the second lever is competitive pricing, which means having the most attractive price of the other kind of peers in your industry. Strategy number 3 is to selectively pursue strategic acquisitions. So this company has a lot of cash in hand right now, and I think they're saving this to conduct a big M&A in the short term. And the final one is to focus on the omni-channel sales strategy. So this, I believe, is a very informal business model, since it's garages, a lot of people, it's more of a need when you're going to buy it rather than something you want, because maybe your car doesn't work, or maybe you got into a crash and you have to repair it. So they're trying to expand this and improve this by offering a way to buy these parts online, so they can unload a bit of demand from their current centers, they can improve the customer experience, and just improve and enhance demand and volume that they're selling in this way. But this company gets extremely interesting when analyzing their financial analysis. They have every single metric is above average and inside the thresholds that we usually like to see them. For example, the return on capital employed is around 22%, which is extremely good. We tend to look for a return on capital employed of above 15%, and every single percentage point about that is an added benefit. Then they have an interest coverage ratio of 20 times, which means that they won't have to worry about debt anytime soon, and they have a very solid cash conversion ratio of 95%. Just to remind you, this is how good the company is at converting their net income into free cash flow. And then they have very solid profit margins of 50% and an operating margin of 20% above the industry's average. We can see that their revenue, their gross profit, and their net income has been growing every single quarter for the past 3 years. And although this company is not a super high growth Nvidia tech company, the gross profit has grown at 10% year over year, and the revenue has risen by about the same percentage in that time. And you can see that the gross margin and the net margin have been extremely stable for this time period. One of the things that I don't like about this company is their balance sheet and their debt position, where, as you can see on the left, that they have more total liabilities than total assets, and this of course causes for the equity to be negative. This is something that I usually outline and pinpoint as being a red flag for companies, because having more total liabilities than total assets for an extended period of time can lead to trouble for companies, especially in their liquidity aspect. However, since they right now have an interest coverage ratio of 20, I'm not so worried about it, but you do have to keep this in mind if you're going to invest in this company. As I was saying, return on equity is very deceiving. Why? Well, because they don't have any equity. Their equity is negative, and if you have negative equity, you cannot calculate their return on equity. Then the return on invested capital, which is the ratio we actually like to look at, is at 26.4%, which is a stunning value for this ratio. When conducting the fundamental analysis, this company gets a solid 5 out of 8 as it has low liability risk, it's very consistent with its cash flows, and it's actually conducting share buybacks, which is very positive for the shareholder. Then they also have organic free cash flow growth, and they have an existing moat/competitive advantage because this sector is something extremely recurrent. If you go to an auto parts manufacturer and you buy something from them and it actually serves its purpose, usually, first of all, you have chosen them because of convenience, meaning that they're close to you. And second of all, if you're actually content with their service, chances are you will not change the auto parts services or the auto parts dealer. However, I don't like that this company does not have a solid balance sheet. As we spoke about, they have negative equity. I'm not a big fan of that. I don't believe that this company has pricing power, since one of their differentiating factors is to offer competitive pricing, meaning that they're competing on pricing. And finally, organic revenue growth. It has been growing, as we have seen. However, I believe that in this last quarter or this last year, it actually sunk and actually decreased year over year. I think this company has a lot of growth potential, since they still have a lot of room to run with in terms of geographical expansion, and they're willing to aggressively open new stores, as they mentioned, and then through new offering development. However, if I was the CEO of this company, before trying to grow the company, I would get the balance sheet right where it should be. This company trades at a PE ratio of 28, which is extremely high when comparing it to the PE ratio it has traded in for the past 4 years. However, when looking at its free cash flow yield of 2.94%, since it's very similar to the 3% long-term inflation rate, this may actually suggest that the company is trading at an attractive valuation. Now, when considering the risk and possible challenges, I do think that this company has a big competitor risk because of the worsening of the competitive landscape. I'm not a big fan of companies that compete on pricing. I prefer those who have differentiated products and compete on their unique value proposition. So I think that this actually leaves them vulnerable for a worsening competitive landscape. I don't believe that this sector will be negatively affected by any possible upcoming regulation changes, and I don't believe that this company has a high risk of not meeting performance objectives. As we know, the auto sector is very, very cyclical, so I put a 70% risk over here since it's an extremely cyclical sector, and just any kind of risk of an economic downturn will heavily influence and affect the sales of this company. Now, before moving on to the investment conclusion, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company, we could say that it has a strong competitive advantage due to its recurring clients. It provides consistent cash flows, which are predictable and resilient, and it has high return on capital employed, meaning that it knows how to create value for the investor. So I do believe that this is a good company and it has very solid fundamentals. However, its questionable balance sheet and its free cash flow growth, which is very, very low, make it for a company that I will keep my eye on, but I will not do anything until the future when they have sorted out these problems. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.